let's finish up the income statement. Let me clean this board off a little bit because we're going to need to finish up the income statement in this clip, and we'll move on to the statement of changes in owner's equity. But let's finish up the income statement in this clip. All right, so we've got, let me grab my pointer here. So we've got, we're going to title the financial statement, and then for which organization we're talking about, and then for the income statement, here's our year. Ooh, let's change that. Let's change that. Let's go ahead for the period. Let's change this. 1/1/2017. There we go. Let's make that right. Live television, right there. This is like going to the theater. You never know what's going to happen. You go to live TV or to a live production. All right. So let's go through the line items here. The top line, okay, revenues or sales. Then we have less cost of goods sold. So these are expenses that are related to revenues. All right, equals gross profit. This is what we make by selling our product. Then we're going to take out SG&A expenses, selling, general, and administrative expenses. So these are commissions, and these are all sorts of all the staff functions that cost a company money. Accounting and MIS and rent and things like that go into all the period expenses. Here are the product expenses, and here are the period expenses. Go there, and that gets, and then we have our depreciation expense, and this depreciation expense is another type of period expense separate from any product expense depreciation, like on equipment that might go here, depreciation of equipment that might go there, and that equals operating profit, or EBIT, earnings before interest and taxes. One of my favorite students graduated a couple of years ago, got married, and they bought a dog, cute little dog, and they named the dog EBIT. What a nerd, but that's a great name for a dog. All right, so that's operating profit. Then we have interest expense. Notice that interest expense comes after operating profit because interest expense is related to what? Borrowing. So borrowing is not an operating cost or expense. It is a financing cost, and that is a decision that is separate. And where do we find financing? On the balance sheet. You find the liabilities on the balance sheet. So that is not an operating decision. That is a financing cost, and that comes after operating profit. And then we have plus or minus the other gains or loss, the peripheral activities. Okay, we separate those out so that people don't get confused there. And that is equal to pre-tax income. And out of pre-tax income, we take our tax expense that we just learned how to calculate in the previous clip, and we get our net income, and we get our earnings per share. So we got the 10 commandments here, and I stuck on a couple more commandments there. 12 commandments there on the income statement. All right, so let's review. The income statement measures the results of operations over a period of time. 3 components: sales, expenses, and income. And then we have accrual, accounting, and matching are really important for the income statement. So accrual accounting, go back and look at the matching principle and the realization principle. All right, just a couple of quick notes about the income statement. What I mean by this is I've seen a lot of problems, a lot of examples that are put into textbooks, and I want to clarify one in particular that might pop up on an exam. Well, you'll see it on one of my exams, but if you go to graduate school, you're going to see problems like this, so I wanted to go ahead and prep you as to how to answer a question like this. It's just some simple algebra. All right, so a firm has net income of $100,000. The effective tax rate is 30%. So this is net income. So where do the taxes go? Well, the taxes come before the net income. The net income comes after the taxes. All right. What is their pre-tax income? What was their? So you have net income. Let's look at it this way. So you have net income of $100,000, and then you have tax expense, and we don't know what that is yet, and then you have pre-tax income. So if I tell you, if you see a problem that says the net income is $100,000 and the tax rate is 30%, you can then back into the pre-tax expense and into the pre-tax income. But if you think that the tax expense is $30,000 and the pre-tax income is $130,000, you're wrong. That is not correct. All right? That's what it looks like, but that's not correct. But the way you do this is the $100,000 is equal to pre-tax income. Well, let's do it this way. Here you go. All right, the $100,000 is 70%. That's how I wanted to say it. The $100,000 is 70% of the pre-tax income. So we're going to put it like this: 0.7 pre-tax income. So we're going to do a little bit of algebra. It's not 30% higher than pre-tax income. It's 70% of pre-tax income. So we're going to do, what happened to my animation there? That's okay. So we're going to divide the 100,000 by 0.7, and that's going to give us our PTI. 100,000. So PTI, we're going to divide that by 0.7, divide that by 0.7. PTI equals 100,000 divided by 0.7. Let's see. Here we go. So our tax rate is 30%. So 1 minus our tax rate, 1 minus 0.3 is 70%. So we're going to take the net income, divide it by 70%, and we get our pre-tax income. So our pre-tax income is $142,857. So that's our net income divided by 1 minus the tax rate. Then we multiply our pre-tax income by our tax rate of 30%, and we get $42,857, and subtract out the $42,857 from the $100,000, and you get our net income of $100,000. So let's look at another example here. Net income of $450,000, interest expense of $125,000, tax rate of 35%, depreciation of $150,000. So there's several things on here. So how do we get our pre-tax income? So by now you're starting to scratch your head, you're starting to work down the income statement. Let's start with our net income of $450,000. Now, this and this are smoke screens. They're distractions. You don't need them. Remember what I said was all you have to do is take your net income, divide it by 1 minus your tax rate. So you've been working back up the income statement, or maybe working down the income statement to try to get pre-tax income. You don't need to do that. All you need to do is take your net income divided by 35%, 1 minus 0.35, excuse me, 1 minus 0.35, and that gives us our PTI. So let's do that. So we have, let's clear it out, second future value, second CEC, and we have $450,000 divided by 1 minus 0.35, which is 0.65, and we get 692,307.69. And then we're going to multiply that times 0.35, which is our tax rate, and we get $242,307.69. So this is our tax, and this is our PTI, and this is our net income. Okay? So, don't fall for this. Don't get into a test and get distracted. You'll make mistakes, and I'll put answers in there that will include this, this, and this, and it won't be right. Okay? So here we go. Take the 450, divide by 1 minus the tax rate, 692,308, multiply that by the 35%, And there you have it. Okay, there was a little bit around there. All right, let's see. I think, we're going to go ahead and do an example here. So here we go. We've got everything we need. Okay, so let's develop an income statement. So let's not do that yet. Let's develop an income statement for this. So let me erase this, and let's go ahead and start doing. Get out your paper and your pencil. Don't be using a pen. It's a quant course. And let's say so. It's an income statement, and it's for Apple Inc. And it's for 1/1/17 through 12/31/17. And we'll start with the top line. So we have sales. And we have cost of goods sold. Okay, watch these acronyms, cost of goods sold. And then we have gross profit. And gross profit's not over there. You got to know that gross profit is part of the income statement. And then you have SG&A, sales general administrative expense. Then you have depreciation expense. And then you have operating profit, operating income, or EBIT. All the same thing. Okay. Then you have interest expense. Then you have other. Then you have PTI. I'm running out of space. Let's move that over here. Then you have taxes. And then you have net income down there. All right. So let's start. So let's go to the top line. Oh, I see cost of goods sold of $11,000. Let's go ahead and put that right there. And then I see SG&A expenses at $1,200 right there. I'm jumping around a little bit. Let's look for sales. Sales, $22,000 right there. 1, 2, 3. Sales, $22,000 minus $11,000 cost of goods sold. So the gross profit is $22,000. It's not over there anywhere. We have to calculate that. $22,000. Then we have SG&A at $1,200. Then we have depreciation of $1,500. So we have $22,000 minus $1,200 minus $1,500. So let's clear it out. Second future value, second CEC. So 22,000 minus 1,200 equals minus 1,500 is equal to 20,378. All right, right there. And then we have interest expense of $750. And yes, we could go like this. We could go like that if we wanted to. Parentheses meaning showing that they're negative numbers. And then we have other. Do we have any other in there? I don't think we have any other there. So we have pre-tax minus $750, and we have pre-tax income of $19,628. And then the tax rate is 30%, 0.3. So we multiply that times 0.3, and we get 58,888 right there. And we get net income of 19,628 minus 5,888, and we get net income of $13,740. And then we're going to divide that by 1,000 shares outstanding, and we get $13.74. Let's see if I did this. Do we have the answer right here? I think we do. Did I do this right? Oh no, I was way off. Way off. Where did I go off? Oh, somewhere in here. I went off somewhere in here. What are we missing? 22,000. Oh, gross profit. Look at there. Dr. E made a mistake. You know what? I'm not going to edit this. We're going to keep it right like this. I made a mistake. 22,000 minus 11,000 is 11,000. Why did I do that? I don't know. So then let's go through. Mistakes happen. So let's go ahead and just use this. Let's use this. So we have 11,000 minus 1,200 equals minus 1,500 equals 8,300 minus 750 equals 7,550. We right there? Yeah, there we go. Now we're back on track. I thought that looked a little bit weird, but mistakes happen. All right, so equals 7,550 times 0.3 is equal to 2265. There we go. Let's put parentheses around there, and plus 7,550, and that's 5285. 5285 divided by 1,000 shares equals $5.29. We're going to round just a little bit. All right, so Dr. E made a mistake. You caught me. There you go. Y'all go have a cup of coffee on Dr. E. Let's see, are we? All right, we're done. We're done with the income statement. We'll move on. We've got 2 more statements. The next one is a minor statement, which is changes in owner's equity. And then we'll look at the cash flow statement, your favorite, the cash flow statement. All right, see you next time.